Hi there, and thanks for joining us on PhillipCapital's Market Watch. I'm Wee Ming Jie, Investment Specialist from Phillip Investor Centre, Holland Drive. In this Market Watch, I'll be discussing about the strengthening of the US dollar and its impact. The US dollar has been and continues to be the world's most important currency. There are a number of reasons for this. It continues to be the world's principal reserve currency, a title it has held since the end of the Second World War. It is the most widely used currency in international transactions. The dollar is one side of around 90% of all foreign exchange transactions and used to account for around $6 trillion of economic activity daily before the COVID-19 pandemic. In the past few months, the US dollar has appreciated significantly against other major currencies, and this would have a significant impact on the US investment landscape and on investors' portfolios as well. If you index the value of the US dollar against the value of a basket of currencies of the United States' main trading partners, such as Europe, Japan, Canada, and the UK, we would find that the US dollar has appreciated around 10% against this basket of currencies in the past few months or year to date. This puts the US dollar at a 20-year high. The euro depreciated to parity with the US dollar in July, while the Japanese yen was at a 24-year low against the US dollar. The Singapore dollar is also down by 3.2% against the US dollar year to date. Why has the US dollar appreciated against so many major currencies? There are a number of reasons for this. Firstly, the US dollar has a reputation of being a safe haven currency or asset in periods of economic instability and market volatility. Hence, as demand for the US dollar increases in turbulent times, its value will also rise correspondingly. Secondly, the numerous interest rate hikes by the Federal Reserve this year to fight inflation have caused capital inflows from other countries into the United States. The higher benchmark interest rates have raised the returns for assets such as US Treasury bonds, which have now become relatively more attractive to foreign investors. Lastly, rising energy prices have severely affected Europe, but has not had as severe of an impact on the United States. This is because, unlike Europe and other countries, the United States is not as dependent on imported oil and gas. Owing to the appreciation of the US dollar, there is an emerging trend of a distinction in performance between companies that have significant international operations that are based outside of the US and those based in the US. Companies that are based in other countries have had their revenues and sales figures go up, while US companies with significant international operations have seen eroded profits, as their revenue is generated overseas in foreign currency and must be converted back to US dollars for accounting purposes. According to analyst estimates, the rise in the value of the US dollar will reduce the earnings growth of the constituent companies in the S&P 500 index by approximately 5%. We can see this trend being played out by looking at two indices: the S&P 500 US Revenue Exposure Index, which consists of companies that generate most of their revenue within the US, and the S&P 500 Foreign Revenue Exposure Index, which consists of companies that generate most of their revenue outside of the US. The companies on the US Exposure Index have clearly outperformed the companies on the Foreign Exposure Index. Hence, we think that investors should pay close attention to the equities of the companies that make up the US Exposure Index, such as JP Morgan, Wells Fargo, Home Depot, or United Health Group. That's all for PhillipCapital's Market Watch. Do remember to like and follow us on social media and subscribe to us on YouTube. Leave your comments. Thanks for joining us and see you soon.